Hi guys, today we're going to look at the types of business organizations. So the types of business organizations we are going to be looking at are our sole traders, our partnerships, our private and public limited companies, our cooperative. We are going to start by looking at some terminology which interlinks between all these types of organizations. First up, liability. So we normally say that a sole trader and a partnership have unlimited liabilities. What this means is, if the business goes bankrupt or bust, the creditors are coming for your own belongings as well as those that are invested in the business or the money invested in a business. So in other words, if your credit goes over and above what the business can cover when you go bust or bankrupt, then they are coming for your own personal car or your house. So it's normally when assets of the business are liquidated and then whatever money is generated from these assets are then paid to the creditors, and if it doesn't cover everything, then your assets are up for grabs as well. Then we say that private limited and public limited companies have limited liabilities. So this is the opposite. So this means that if you are a shareholder in a public limited company, you only stand to lose whatever you have invested in the business. So in other words, any money you have paid towards getting those shares, that is what you can stand to lose. Next term, legal identity or no legal identity. So we say again that private and public limited companies have a legal identity. What this means is that the business exists separate to the owners. So if we take, for example, the Edcon Group. Edcon conducts business in the name of Edcon and not of the founders. So in a sole trader or partnerships situation, they have no legal identity. So if you have a little cafe and it's run in your name, or say it's Angela's Cafe, then there's no separation between you and the business. You are one. So if you get sued in the business name, you are getting sued as well. Whereas in our Edcon situation or example, they won't get sued. Only Edcon will get sued and not the owners. That is our legal identity. So it's like the same if you or as a person you have a legal identity, the same with a business. It's kind of like they are a person. Next, continuity. So we say that a sole trader and a partnership have no continuity. So in other words, if the owner of a sole trader had to die, the business can't continue as per usual. There are some legal aspects that need to be looked at before they can. Yes, the son and the daughter can take over the business, but like I said, legal issues that need to be covered before they can do so. With a partnership, same story. If one of the partners passes away, then legally they have to re-look at how to go forward. It's not business as usual. But when we're looking at private and public limited companies, if one of the shareholders or one of the directors passes away, unfortunately, then business can continue as usual. So we say that they have continuity. Next term, incorporated and unincorporated businesses. We say that a private limited and a public limited company are known as incorporated businesses. What this means, again, going back to the legal identity, is that these businesses have a separate legal identity. A sole trader. A sole trader has one owner. That owner makes all the decisions. They also have unlimited liabilities. They have no legal personality. There are few legal requirements in order to start a sole trader. Sometimes just an operating license is required. They have very limited capital. So capital means the money invested in the business. So whatever they can get in terms of loans, or if grandma gave them some money to start the business, it's very limited. And this one has the least capital of all our types of businesses. An example of a sole trader could be anything, like I mentioned before, Angela's Cafe or Giuseppe's Restaurant. Partnerships. Partnerships normally have 2 to 20 partners. They also have unlimited liabilities, like your sole trader, except for silent or limited partners. These are partners that invested money in the business or invested their skill in the business and want no part of the liability section of the business. So in other words, they are exempt from the liability. Then a partnership also has few legal requirements. Obviously, you should if you are clever, should sign a partnership agreement. This can be verbal or it could be drawn up by lawyers. It is obviously better to have a written agreement between the partners. Otherwise, it's your word against your partners. So they also have lack of capital, meaning they are limited in terms of funds that can be provided by the partners or that they might get in terms of loans. So examples of partnerships would be your attorneys normally have partnerships, your doctors normally have partnerships, even some of your vets, your veterinarians would have partnerships. Next, we have our joint stock companies. So joint stock companies, we have private limited companies and public limited companies. I'm going to look at my private limited companies first. So in my private limited company, this is normally established when businesses want to kind of protect themselves, to have that separate legal identity so that your personal belongings can't be touched in terms of your liabilities. So they form private limited companies. It could be anything from a small business to a big business. Previously in South Africa we had closed corporations. Today no newly registered closed corporations are registered. So businesses need to go and opt for private limited companies. In a private limited company, they have limited liabilities. They also have continuity. They have a separate legal identity. They also sell their shares or issue their shares to friends and family or authorized people or authorized shareholders. So in other words, they can't go and sell their or issue their or resell their shares at random. It needs to be approved first. And they can also not sell their shares on a stock exchange or a security exchange, as a public limited company can do. So they're limited in that respect. They also have to hold AGMs, annual general meetings. I just want to go back to the shares. A share is normally a certificate that says I have X amount of shares in this company, or says I have shares to the value of X amount, and that normally says that if depending on how many shares you have, you can say maybe have a 20% investment in that company. So 20% of the company basically is yours. So directors run a company. Directors are people that are voted for at these annual general meetings, and they basically run the show. So it's not that all of the shareholders are all of a sudden running the show. That could be chaos. So in a family-run private limited company, maybe the mum and the dad are the directors, or just maybe the dad, or maybe one of the sons, depending on his qualifications or his experience. He might be voted in as a director. Private limited company also must make sure that they have annual accounts or financials available. So in other words, their income statement, their trial balance, their balance sheet, those type of things. And this is normally signed off by a chartered accountant. You can't just have one of your little accounting friends sign it off. It needs to be signed off by a chartered accountant, because that is relevant for your revenue collectors. They want to see this. A public limited company. These are companies that are quite big, and they are listed on the security exchange. It is not an easy thing to do. There's a lot of red tape that needs to be gone through in order to be put on the security exchange. So a lot of times businesses remain private limited companies because they don't want to jump through all of these hoops in order to become public. Public, I just want to emphasize this, is not government. And please don't go and write this in your essays or in your exam, students. Just leave it out. Just make a mental note that a public limited company has nothing to do with government. It just means that they are listed on the stock exchange or the security exchange. So in other words, the annual accounts are published and is available to everyone, any potential shareholder. So you can go and Google them, and you can go and visit their websites, and these financials need to be made public. You also get these financials put into a prospectus that is normally put out yearly or depending on the company, and these prospectus are available and has anyone from the CEO to plans for expansion, financials, anything listed in those or put into those prospectus booklets. They are normally very expensive to publish, so it's not your newspaper type of paper that they are printed on. They are done quite nicely. So normally you have people that are looking around or shopping around for the best investment for their money, or the best return they can get for their money. So they will come and invest in your business if you are listed. That means they are buying shares in your company. That means it is capital for your business, so you have quite a bit of capital. So a public limited company normally has the most potential for capital, for money invested. And when you have shareholders that are investing, they normally want a return, so they want a dividend paid out to them. The best way I can explain a dividend is, say you put money in a bank account, in a savings or a type of investment account at the bank. You want interest, correct? The same goes for shareholders. They put their money into your business and they want some kind of return. We don't call it interest though, we call it dividends. And the other thing they are also looking at is where or which company has the highest share price. So if your company is not doing so great, then they are going to shop around for other companies or to invest in other companies where the share price is higher. So they're going to take the money out of your company, they're going to sell their shares, and they're going to put it into the highest paying company, or the company with the greatest potential for return. So public limited companies have shareholders. These shareholders own the company, and these shareholders can vote at these AGMs also held for the new director or directors who will run the company on behalf of all the shareholders. Obviously, the more shares you hold in a public limited company, the more voting rights you have. So you have more power in terms of your votes. Then in a public limited company, you also have limited liabilities, and you have continuity and a separate legal identity. So those are my two joint stock companies, my public and my private limited company. And in the word limited, or in the name public limited and private limited, the limited means they have limited liabilities. That is what it means. Then with these companies, they have to be registered with the Registrar of Companies. This registrar will then hold all information about the company in terms of the amount of shares that are authorized and the amount of shares that are issued. Authorized means that you are authorized or approved to issue X amount of shares. Say you have registered with the Registrar of Companies that you have 200,000 shares that you are authorized to issue, and you only issue 100,000 of these shares. So your authorized amount would be 200,000 and your issued would be 100,000. Meaning you still have 100,000 shares left that you can issue at any stage. But if you want to issue more than that 200,000, you have to go back to the registrar and obviously ask for a new amount for them to update the systems as well. With private and public limited companies, there are quite a bit of paperwork that needs to be done. And like I said, visiting the Registrar of Companies as well, or sending in your online application for these things. You have to receive a certificate of incorporation in order to start business. If you start or if you are conducting business before that certificate has been issued to you, you could face legal consequences. Next up, we have cooperatives. Cooperatives, sometimes to most students, it's a little bit of a foreign concept because we lack examples or a lot of examples in this field. So we have producer and retailer cooperatives. So a producer cooperative, they normally pool their resources together, and typically an example would be your farming communities or the areas where there are a lot of farmers, and they will have their local cooperative that way you can go and buy your grain at a cheaper price. You can actually also sell your harvest through them as well. You can buy cheap machinery or tractors or whatever you need. So in a retail cooperative, it's a group of consumers that kind of look out for each other and look out for discounts that will benefit the whole consumer group. A typical example that we can use is in South Africa we have Groupon. So Groupon looks out for good deals in terms of accommodation, restaurants, those type of things. But it also benefits the producer or the retailer as well, because these retailers use the platform of Groupon in order to sell their products or get their name out, especially when the business is still small and trying to get their name out. So these deals would be good for the consumer, and that's the best example in terms of a consumer cooperative. So where consumers get together for the best deal. Whereas in the producer one, it's the producers that pool their resources together in order or for the benefit of the whole producer group. So characteristics of cooperatives are that they have limited liabilities. They also have one vote, so it doesn't matter how many shares they have in this cooperative, they have one vote. And it's for the benefit of the community, or for the producer, or for the consumer. In a cooperative, all the members work towards the running of a cooperative. And profits are also shared amongst the members of this cooperative. Those are the characteristics. Thank you guys for watching. Please like this video and subscribe to the channel. Thank you. Bye.